NSC diagnostic reports consistently identify corporate ledger questions as the primary source of lost marks in the Grade 12 accounting examination. A company operates as a separate legal entity, where ownership is distinct from daily management. This separation creates a stringent reporting structure governed by the Companies Act and IFRS. This reporting structure is driven by 6 specific accounts, designed to track the flow of capital, tax obligations, and dividend distributions to shareholders. Using the Winelands Ltd case study, we can reverse engineer a trial balance to see exactly how these accounts must interact. We will build these accounts from scratch to address the specific calculation errors that frequently lead to lost marks. Mastering this section requires following the logical movement of wealth through the ledger system. The ordinary share capital account serves as the foundational equity vault, recording the historical capital raised through share issues. The Winelands account opens with a 2.1 million Rand credit. On August 31st, new shares add 2 million Rand. A critical calculation occurs November 30th, when directors repurchase 120,000 shares at 6 Rand 20 cents. Section 48 prohibits reducing share capital by market price. Instead, we use the average issue price. Dividing the 4.1 million Rand total capital by 1 million issued shares gives 4 Rand 10 cents. Multiplying 120,000 shares by this average yields a 492,000 Rand debit. This leaves a 2 Rand and 10 cent difference between the average price and the 6 Rand 20 actually paid to the shareholder. Since the core capital is protected, this excess repurchase premium is drawn from the company's accumulated historical profits. The retained income account functions as the corporate treasury, serving as a financial shock absorber for the company. The account opens on the credit side with 737,100 Rand, representing profits held from previous financial years. We must now apply the 2 Rand and 10 cent premium from the share repurchase. This premium refunds historical profits to the retiring shareholder. Multiplying the 120,000 shares by the 2 Rand 10 premium gives us a 252,000 Rand debit to retained income. Candidates frequently debit this account with the full repurchase price of 6 Rand 20. This error causes incorrect balances for both equity accounts. The structural purpose of retained income is to absorb these premiums, ensuring the core ordinary share capital remains undistorted. Dividends are an appropriation of profit. Calculating them correctly requires a strict mapping of the company's transactional timeline. The Winelands data reveals 3 key dates: the August 31st interim dividend, the November 30th buyback, and the February 28th final dividend declaration. On August 31st, new shares do not qualify for the interim dividend. The 25-cent payout is calculated only on the 600,000 original shares, resulting in a 150,000 Rand distribution. At year-end, the final dividend is declared. The active share count must be adjusted. Subtracting the 120,000 canceled shares leaves 880,000 active shares to receive the 42-cent final dividend. There is a distinct difference. Interim dividends mean completed cash payments. Final dividends create legal obligations. Because no cash has been paid, the contra account is a liability, shareholders for dividends. Calculations based on authorized capacity or overlooking critical transaction dates will cause mathematical errors across all financial statements. The SARS income tax account tracks the balance between the statutory tax expense and the provisional payments already made. A credit balance indicates a liability owed to the state. A debit balance represents an asset refund due to the company. We record an 8,500 Rand opening liability on the credit side, followed by the final tax expense of 442,500 Rand. The ledger must result in a 5,000 Rand debit closing balance. Missing provisional tax payments are treated as an algebraic requirement. Balancing the T account reveals total cash paid to SARS. Dividing this identifies 2 provisional payments of 223,750 Rand each. Trusting the double-entry balancing mechanics allows for a precise reconciliation of tax cash flows. At year-end, the appropriation account serves as a clearinghouse that momentarily replaces individual current accounts. This account provides a diagnostic test for the accuracy of all preceding calculations. We credit the account with the total net profit before tax of 1,475,000 Rand. This profit is distributed systematically, first to the state as tax, and then to the shareholders as dividends. We debit the income tax expense of 442,500 Rand and the total ordinary share dividends of 519,600 Rand. The remaining 512,900 Rand is the net profit retained for the year. This final debit entry leaves the appropriation account perfectly balanced at zero. This residual amount is then transferred to retained income, completing the accounting cycle. Success in corporate ledgers depends on applying the average issue price, mapping dividend timelines accurately, and using ledger balancing to find missing values. Following this logical flow of wealth ensures that the trial balance remains mathematically sound and compliant with statutory requirements.